If you can get past the understanding of why is Warren Buffett sitting on so much cash and you're still comfortable going in at this time, that's totally okay. But you can't ignore that. One of the most successful investors in history is doing that. Why? And if you take the opposite approach to him, why does that make sense for you?
Welcome to Multiple Perspectives. I'm David Lofgren. I've been thinking a lot lately about market timing and how investors adapt when the strategies that have worked for them stop working. We're seeing multifamily sponsors struggle. We're seeing investors who are suddenly pivoting into private credit, and some experienced players are just sort of sitting in cash, sitting on the sidelines, waiting to see how markets are going to move. It raises an interesting question, which is how do you know when to change course versus when to stay patient? My guest is Jeremy Roll today, president of Roll Investment Group and co-founder of For Investors by Investors, which is California's sort of largest non-institutional real estate investor meeting series. These guys get together once a month and discuss investment strategy. It's fascinating. You'll hear about it in today's episode. Jeremy manages $500 million in assets as well and has been navigating market cycles since 2007. What caught my attention is Jeremy's belief that we might be approaching an end of the cycle reset. Jeremy's currently holding treasuries despite the low yields, and he's got some pointed concerns about folks who are sort of moving recently or have moved recently into private credit. We'll explore his framework for reading market cycles, but we'll also discuss why he thinks many investors are making reactive rather than strategic decisions, and what he's watching for in the months ahead. Let's get started. Jeremy Roll, welcome to Multiple Perspectives.
Thanks for having me here, and thanks for everyone who's listening. Hopefully it'll be helpful for everybody.
I have no doubt that it will be. You have been an LP investor for a long time, have lots of experience in that world, and you're also the co-founder of a group called For Investors by Investors. Phoebe, I guess, is what you guys refer to it as. That group started in 2007, is that right?
Yeah, that's right. Yeah, that started in 2007, basically right after I left the corporate world.
It's a huge group, right? I mean, you guys boast sort of the largest monthly non-institutional real estate meetings, at least in California.
Yeah, that's right.
Obviously, the last couple of years have been interesting, fairly tumultuous time for investors. The volatility and the uncertainty persists today. I'm wondering, as someone who is engaged with such a large group of retail or sort of non-institutional investors, what's the tenor of the conversation these days? Like right now, how are things feeling sort of in broad strokes?
It's a great question. And our Phoebe meetings are really non-institutional investors, and that most of them are what I call active versus passive. So they're not investing in syndications. Most of them are buying properties, and they're typically 1 to 4 units. That's one conversation, because call it single family or small multifamily homes is kind of doing one thing. And then you have what I call commercial, which is, multifamily on a larger scale, and all the other asset classes that go along with that are all based on income. And they're having a completely different experience. And frankly, 99% of my focus is on that more commercial side, because that's what I invest in. But I talk to a lot of people also who are doing the smaller properties. On the single family side, probably the smartest investor and best researched California investor that I can think of, that I know, is Bruce Norris. For those of you who've heard of him, he's just got an amazing reputation. And he came out a few years ago and said, based off of lack of supply and interest rate lock and everything else, that people are kind of stuck in their homes with their interest rate, he forecasted that the way affordability would come back, because right now we're at almost peak on affordability, which is basically end of cycle timing, is for prices to go sideways roughly. Now that could be a little bit up, a little bit down over time, and for wages to increase over time to make up for the lack of affordability, because he didn't foresee a huge amount or a huge wave of supply coming on to disrupt pricing. So, and that's actually what's basically been playing out. Now, that's very local, right? If we're having a conversation in Florida or Texas or other areas right now, that is not the conversation, right? In many cities, right? Many cities are hurting, but most of the areas in California out here, that's the conversation. So what's challenging for investors is that there has been a much lower level of transaction volume out here. And because of that, buying a house and flipping it is more challenging, because you don't know if you're really going to get the buyer, right? Interest rates have been held high for very long, so that causes buyer challenges. And so the outlook for an investor doing that type of model is very murky at the moment. And so there's much less volume of investors doing their thing, right? So that's the single family side.
And it sounds like what you're saying there is that sort of a stressor on both sides, not only trying to, let's say, acquire a property to exact your business plan on, but also if your business plan includes, which most of them do, an exit, especially a near-term exit, or if you're currently an owner of properties, that there's also some stress there as well, right?
You're exactly right. It's both sides, which makes it twice as challenging, right? And so, which makes people less likely to want to participate in the same volume they used to, if at all, right? So that's the current state of kind of the investor side of things on that side. And by the way, just to be clear, in California, at least in most of the cities here, you're not having major declines. San Francisco being a bit of an anomaly, but in Southern California where I am, you're not having major declines. You may have small price adjustments down. That's not going to kill somebody who's flipping a home if they're buying it at the right margin. But the ingredients are not there for a flourishing type of investor environment at the same time. On the commercial side, right, what I was talking about before, that's a whole different ball of wax. That really changed dramatically in 2022 as of March when interest rates started to increase. And it's caused a lot of challenges. Multifamily and office are probably the two hardest hit asset classes. On the non-institutional side, multifamily is the hardest hit. On the institutional side, office is the hardest hit. That's what I would say. And so on the non-institutional side, a lot of people are like looking at anything but multifamily, and that's been the mantra for at least a couple of years now, going on 3 years. What I would say though is that a lot of non-institutional investors have actually exited the market completely, have been completely disenchanted by the lack of cash flow, cash calls, lack of hitting pro formas, and a lot of them were new because as of all the money printing that occurred in 2020 and 2021, a lot of money came in that was new and they had certain expectations. But I think unfortunately, a lot of them being new weren't taking cycle timing into account and other risks like floating rate loans. And now they're unfortunately getting burned in mass quantities. And it's really unfortunate. So it's very difficult for sponsors to raise capital right now. So liquidity on the equity side is rough. A lot of sponsors are just treading water, trying to keep their current deals alive that have been going sideways, if not down, for a couple of years. And it's a challenging time right now. And I think actually things most probably are going to get worse before they get better. So it's a very challenging time right now as we sit in 2025 recording this, because at the moment, equity is hard to come by. Debt is still available, albeit at high interest rates. I think we're going to get to a period where equity will be even harder. And I think debt is going to become difficult to get, probably during an end of cycle reset. And then eventually it'll be a fantastic time for investors to jump back in.
Very interesting. I'm curious, in this sort of investor group that you're a part of, that you helped to found, oftentimes in the middle market sort of platform space, Equity Multiple and those folks that compete in the same space, many of us have shifted towards hard money lending, debt lending, sort of looking at the pullback in capital from banks in that space and understanding that we can, sort of offer investors a potential for actually making some favorable returns and with, significantly less risk than, let's say, an LP investment. Do you see that happening for all types of retail investors? Is this something that people are talking about in investment groups, or is getting into debt lending or hard money lending, is that just like a little bit too outside of the normal field of let's say equity investing that most people have experience with, if they do have experience at all in the sort of commercial investing space?
It's a great question. And honestly, the term private credit has become very en vogue. But the fact of the matter is that that's just debt on private debt. And that's been going on for decades, right? If not longer than that. And in fact, I did hard money lending myself every year from 2009 to 2022, except I stopped in March of 2022. First interest rate hike, I stopped. I was out of all my loans by the end of the year, and I'm waiting to go back in. So what's happened, to your point, is that when I say anything about multifamily, everybody was trying to pivot to other things to keep their money working. And one of the things they went to is private credit or debt, and also hard money lending, which is a form of debt. And I fear, so there's been pivots to that. There's been pivots to oil and gas. There's been pivots to some other things like roll-ups of businesses. I fear that what got people in trouble with the floating rate loans is kind of the same problem with pivoting, which is cycle time. And I am very into macroeconomic thought and trying to think way ahead, because when I invest just my own little box, I typically get into a 10-year fixed rate loan. I have to think way ahead, right? Both in terms of is that type of asset going to be in demand in 10 years from a kind of consumer preference and stuff and just general society trends? But also, is that going to get through a recession or whatever else might be coming up? And so imagine we were talking about this at the beginning of 2007 when just cycle timing wise, right? Knowing that a reset might be coming up in a year or so. If I said to you, I need to pivot to something else because multifamily no longer makes sense, the answer you'd probably give me is, oh, that's a bad idea. Not much is going to make sense in the next year. Right. And that's the problem I have right now with people who are pivoting. When you pivot to oil and gas at the end of an economic cycle, what appears to be the end of an economic cycle, that's a bad idea because in a reset of an economic cycle, oil prices go down. Right. That's just what happens. Less demand equates to lower oil. That's just every time or most times. If you're pivoting into debt, yes, you're taking a safer position, but you're also going straight into a situation where the value of debt declines dramatically during a downturn because investors don't want to pay as much because there's a lot of uncertainty, right? So the value of the assets you're investing in will go down and the risk goes up. And that's because if we get our end of cycle reset, property values often go down. And all of a sudden, your loan to value, which was 80% before, maybe negative 10% now. And so all these risks happen at the end of a cycle. So to pivot to these other things to me, I understand why people are thinking to do it because, oh, they're reacting. It's being reactive to what happened, but they're not being proactive thinkers into like, is this going to make sense in a year or two or three? They're just jumping into it as a reactive measure. And I'm very concerned for people who've done that. And I will just add one more thing. In fact, it's already been so long, these 3 years since the interest rate increases, that people, and what I've found is that people have gone into private credit, tried it probably from 2023 and a half, 2024, and they're already starting to shy away from it because some of it is already not working because of a little bit of distress that has occurred. And that's already becoming something that people are favoring less. It's like already come and gone, actually. So I think that it's just a very important time to be very careful right now. We haven't had a proper end of cycle reset yet.
So what does the smart money do in this moment? If we're looking, if your predictions here are true and we're looking at the end of the cycle, but we're not there yet, is there a smart place to keep your dry powder? Should we all just invest in gold and put it under our beds? Like what's the best move here?
It depends on your risk tolerance and it depends on your opinion about where we are in the cycle, because I'm just giving you my own opinion and it could be right and it could be wrong for sure. Right. So, but if you believe it's the end of a cycle, then you do a couple things. One is you could take advantage of what occurs at the end of a cycle if you're willing to take more risk, or you can stay on the sidelines completely and go into something like treasuries or municipal bonds or other cash-like options. I'm personally in a lot of treasuries, and I've actually been in a lot of treasuries for a couple of years right now to this point for that reason. They're tax efficient. I'm in California. I don't pay any state tax. The risk is relatively low. I don't like the yield. I don't like the yield at all, especially not being a full-time investor who's trying to keep up with inflation. But I think it's the best alternative for me at the moment. I will also say that, dare I say this, because this is like 1% of what I focus on, but I just took a position in Bitcoin within the past month. I personally believe we're going to have end of cycle kind of blow off last top in Bitcoin specifically. It's a 4-year cycle each time. So I'm making a bet on history, which is what I like to do, and kind of applying it to what's happening right now. As we're recording this, we hit an all-time high. We kind of came off it a little bit. Bitcoin is very stressful. It goes 24/7, unlike the stock markets. You have to watch it. You can go to sleep tonight, wake up tomorrow, and it's crashed, or vice versa. You have to be willing to deal with that. But I do have a position in that, kind of just making a quick bet. And if I lose that bet, I'm totally okay with it because I'm going with the probabilities. That's the way my mind works, right? But that's one option. Silver and gold have been going up. The problem is all of these assets, unbeknownst to a lot of people, are like maybe not contrary to what you might hear. If you look at all the charts, they all tend to come down in an end of cycle cleansing. And Bitcoin will probably crash 80% based on history, which is huge if you hit it at the wrong time. So, there are things you could do end of cycle, but they're high risk, high reward. You have to be okay with that. And you can also go low risk, which is what I'm not a financial advisor, but that's most of what I'm doing basically.
Sure. And whatever that Bitcoin position is, as you said, you're prepared to lose it if the bet doesn't play off.
Because if you say, would you do it over again? Even if I lose money, I'd say yes, because it's a once every 4-year opportunity from a probability perspective. And I like if Magic can go into a casino and say, there's a 75% chance you're going to win this game, I would take that bet again, right? Even if I hit the 25,
right.
Because those are good odds, right? So that's kind of the way I'm looking at it.
I'm curious, you're based in California. This investment group that you spend time engaging with is in California. California is oftentimes sort of the butt of the joke when it comes to real estate investing. How do you, as a Californian, as someone who's actively operating in those markets think about real estate in your state? And, do you feel like you've been able to, I don't know, gain some sort of efficiency or some edge as someone who's operating in that space to understand maybe the inefficiencies in specific markets or specific asset classes?
Yeah, let me explain the for investors by investors for a minute so everyone's familiar with it and why it's out here, and then I'll explain kind of my focus because it's actually different probably than you think. So, for investors by investors was co-founded by me and one other person, Ellis San Jose, in 2007. It's a pure nonprofit. We actually lose money off it each year, but we try to help support the investor community. We lose like a few $1,000s between us each year, and all it is public investor meetings. I used to go to public investor meetings in LA 2 to 3 a week between 2002 and 2007, trying to find syndications or passive opportunities. And when I finally left the corporate world, I decided to launch my own because I was sick and tired of getting sales pitched. So I would go to meetings, sit in it for 2 hours at a time, do work in the back row that I brought because I was in the corporate world. And then I would go network with people at the end. I was there to network, right? And then literally the first meeting I went to after I left the corporate world, I'm sitting there and I literally have this moment where I'm like, oh, I don't have work to do for 2 hours. I have to actually sit through this sales pitch. What a waste of time.
Right.
And so I said, why don't I just have my own meeting if I'm going to have to sit here for 2 hours anyway? The core foundation for investors by investors, there's no sales pitch. That's the reason why it was founded. So we try to break even on the cost of the venue. You're not going to be sold anything in a meeting. We are hardcore about that. We know the speakers who we bring on. We've known them for years. They're not allowed to pitch anything. It's all educational for networking purposes. So that's actually in-person meetings for the most part. And because of that, most of those meetings end up springing up in Southern California, right? I don't actually typically invest in Southern California. I invest out of state. And the reason is because I am a staunch cash flow investor. So I got into all this in 2002 as a response to the dot-com crash, for those of you who are old enough to remember that, because I was sick and tired of the volatility and the lack of predictability of the stock market for my own long-term retirement account. It's just all about predictability and lower risk. And that was not a good solution for me. So I started to look at different ways, came across cash flow and the concept of going into syndicated real estate for cash flow. And that's what, and my focus ended up being. But if you're looking for cash flow, California is not a very good solution as a general mention, right? Because prices are very high and cash flow tends to be relatively low here. So as much as I'm a bit in tune with the California market here, I actually typically invest out of state for better cap rates and better cash flow. So that's the irony. I'm located here because my wife's family is here, so I've been stuck here for like a couple of decades, and that's just my reality. And that's the God's honest truth. I wouldn't be living here otherwise. California has a lot of pros, but boy, there's some problems here. So anyway, so that's kind of the background. So the group that I basically co-founded is a lot of smaller single family and small multifamily investors. Not what I do, but a lot of really good networking and a lot of discussing of local markets here. But that's not what I focus on for myself. So I'm constantly networking with other investors across the U.S., going to conferences across the U.S. I'm having these types of conversations to try and stay on top of what's going on in the markets.
Interesting. Okay, so the group that you are engaging with a bunch of people who are sort of directly invested in California markets, right?
Yes.
And what's the feeling there? I mean, I was just speaking with someone on another podcast. We were talking about how, if you're in the stage of your investing career where you're investing directly, or you're sort of more interested in the real hands-on approach, the active approach to real estate investing, sometimes, diligencing, let's say, a property or a deal can feel a bit more just intuitive. I think you can walk through the building, you can sort of kick the tires, so to speak, and see how these assets actually look. And then you can look around the neighborhood, right? You can actually visit the comps. You can really sort of get an intuitive sense. Do you feel like in at least the active market in California, people are finding inefficiencies, finding spots where they feel like they can actually still get a good return in that type of active investment?
Yes. And what's interesting about California is, and particularly let's say Los Angeles is where I lived for about 20 years until a few years ago, it's very dense. And it's also not the newest city, in terms of all the build and the average build date of something. So, and it wasn't a planned community. So it's not like, there's all these 90s homes clustered together and they're all the same. So there is a lot of opportunity because of that to go cherry pick a home that was built in the 1920s, 1930s, 1970s, 1960s, whatever you choose, and go ahead and improve it. So there is a mass number of homes that you can go in and rehab, and in some cases even remove walls, make it a more open, modern floor plan, and really add value. So there is a ton of opportunity here for people. And I mean, it's so dense that you can work within literally a 4 square mile radius or 5 square mile radius and just have endless opportunities for years. Right. And I'm really not exaggerating. That's a big advantage you can have in working in a city like this. That is not at all possible in many cities across the US. Right. And furthermore, because prices are so high here, if you get the right deal and you really cherry pick the right deals, you can create a really good margin for yourself. In many cases, higher margins here than in other places. I'm talking about absolute dollars, right? Percentages may be similar, but you're making absolute dollars more for the same amount of work and time. So there is a ton of opportunity here. The problem, as we mentioned before, is that right now those opportunities are not as plentiful as normal. And arguably at this exact timing, we're seeing a slowdown in terms of volume and pricing in a time at which normally in the spring season you'd be getting a pickup. That is very worrisome, unusual trend that could be hinting that prices may start to come down a little. And if I know one thing about investing, the last thing someone who's flipping a home wants is to be investing in a market where they think there's a pretty good chance prices are going to come down in the next 12 months, as opposed to at least stay flat, if not go slightly up, right? They're working against themselves. They're taking on a lot of risk. And don't forget, when someone's flipping home, they're not usually using their own money. And so the clock is ticking, and they may be working against time and a market that's working against them, which is not a good formula.
Yeah, I wonder if, as someone who's been investing in real estate through the Great Recession, through pandemic, you've seen several, let's say, black swan events, several sort of opportunities, or not opportunities, but situations where things have gone sideways. But, you're still an engaged commercial real estate investor. It's still an asset class you believe in. I wonder, as people are looking to real estate, that there's always some wave of folks coming in saying, well, I've done public markets, maybe I've invested in a REIT or two, maybe I have a quadruplex down the street, but I want to try and actually get into this more sort of diversified, lower barrier to entry commercial real estate type of investing. If they're arriving to this mindset in this moment, what is that like? If they're looking around and they're talking to the folks who got in 2002 and, deals went sideways because they weren't anticipating whatever, happened over the last several years. If they're talking to people who, have sort of started to dabble into this credit lending, and things are already the pro formas aren't actually, working out the way that we anticipated. How are people supposed to look at real estate, today? Is there a good way to get into it? Is there a way to start dipping your toes in if, as you're saying, we might just be reaching the end of the cycle here and it might be, I don't know, smarter broadly to hold back for a little while?
Yeah, there's a lot of negative sentiment. If someone starts asking around and asking the opinion of a lot of investors, they're going to come across a lot of investors who have recently been burned or at least aren't performing from a cash flow perspective, which is really not good for some people who are depending on that. And so here's what I would say. It can be potentially a fantastic time to learn if you're brand new right now. And reason being is that, depending on your opinion about cycle timing, we may have an end of cycle reset in the next 12 to 18 months. And if we do, it's a fantastic time to learn. So by the time opportunities start to come up, and they are coming up slowly right now, then you are in a very well-educated position at that point to jump in, right? And so it's not bad timing if you're sitting there right now thinking, maybe I'll get into this, to start learning for sure. I think you just have to be very cognizant about, at the very least, educate yourself on what occurred because of 2022 interest rate hikes, where the carnage has been and where it is currently, what the risks are of investing with a sponsor right now who may be dealing with some of that carnage on an ongoing basis, right? Which asset classes have been hit harder than others, which locations have been hit harder than others, because that's a big thing too. And then make a well-educated decision on, okay, what asset classes maybe make sense to start with. And then furthermore, always create and do enough research to end up with formulating your own opinion about where we are in the market cycle. Because I'll tell you, I've been through so many of these phone calls where somebody calls me up and says, hey, I just sold my business. I made $10 million. This money is burning a hole in my pocket. I need to turn into cash flow because I'm no longer working. I need cash flow. And I always love hearing those stories because I'm an entrepreneur at heart. So I love hearing someone doing really well like that. But the first thing I say to them is, that's fantastic. Congratulations. But had you thought about where we are in the cycle, do you at least have an opinion about it? It doesn't have to be the same as mine, but you have to formulate an opinion because if you haven't, you need to avoid a landmine that you didn't even realize you may think is there. Right? And that I think is what's so dangerous. So if you're brand new and you haven't thought about that, you haven't done the economic research, I think it's absolutely critical because any business plan you're going to look at that was created by a syndicator, if someone's buying a property, they're going to have a business plan that makes sense for that property today based on their sales pitch. Otherwise, they wouldn't be buying it.
Right. They'll have a story to tell no matter what.
Absolutely. So the question is, do you
Yeah.
agree with it? Do you agree with the cycle timing? And I cannot stress that enough because unfortunately, a lot of new investors, I think, tend to skip that step. And that step is so critical to protect yourself. And that's how people get burned, unfortunately.
Sure, that totally makes sense. I wonder, we're almost out of time here, but I wonder before we leave, if you could, let's say that our listener is in that position. They've stepped into a windfall. They're ready to jump into commercial real estate, to alternative investing, to sort of broadening their horizon of what personal finance actually looks like. You're saying that they need to create an opinion. They need to develop an opinion. And I'm guessing that you wouldn't be satisfied with them saying, cool, I'll just take Jeremy's opinion and I will go with that. What are the factors that you think, this person should start to look at in order to develop their opinion? Are there a few things that you would say, okay, figure out this, and this, and like that can be the basis for your opinion? How do you start to do that?
The first thing I would do is talk to as many past investors as possible who have been in this game for a long time, who maybe have seen some cycles, and start to hear about their opinions and start to think about what the feedback of what they're telling you. Do you agree with it or not? Does it make sense to you or not? That's number one. Number two is take a look at stock market charts, okay? And because it's cyclical, take a look at those charts, take a look at PE ratios and those multiples of stocks, and get an education or at least get an understanding of why is it that the multiples are so high today compared to before? Why are we at like practical to .com multiples? And what does that mean, right? Why is Warren Buffett sitting on so much cash? If you can get past the understanding of why is Warren Buffett sitting on so much cash and you're still comfortable going in at this time, that's totally okay. But you can't ignore that. Like one of the most successful investors in history is doing that. Why? Right? And if you take the opposite approach to him, why does that make sense for you? And frankly, it could make sense in certain markets. So certain markets have already corrected a certain amount, right? Certain markets are in free fall and there maybe could be good deals. There's always unique opportunities out there too that make sense at any time in the cycle. So, but those are the types of questions that you need to be asking yourself so that you are 100% fully educated on, okay, the cycle we're in right now has been going for X amount of years. By the way, if you discount the supposed 3-month recession we had from the pandemic, which I don't personally believe because that's not the real definition of a recession typically, then we're in a record long economic cycle right now. Now, if you believe cycles no longer exist, great. But if not, what does that mean? Does that mean that we have a very high probability of a cycle reset soon? Possibly, if we're in a record long cycle already, right? You have to be aware of all these things. If you didn't even know that fact, that's the type of stuff I'm talking about. So you have to go educate yourself in terms of what's going on in the space I'm about to get into and get some good opinions, and what's going on in the general economic cycle in general, along with the stock market. Put it all together and then formulate an opinion of, does this space make sense at this point in time?
Well, Jeremy, if people want to follow along with how your thesis evolves in the coming months, how can they do that?
Yeah, to be honest, there's no good way to follow me, so to speak. I'm not on social media. But if anybody, I've been on over 200 podcasts. So if you want more content that I've been on, or even recent one, you could just Google my name, Jeremy Roll Podcast. I've been on over 200 podcasts, so you can get a little bit of that. If anyone wants to reach out to me directly, they're more than welcome to reach out to me. I'm happy to help anyone any way that I can. So my email is the best way to reach me, which is jroll, JROLL, at rollinvestments.com. So ROLL investments with an S.com. So jroll at rollinvestments.com. Also, if you go onto LinkedIn, I am on there. You can look at my bio and see that I was in the corporate world before, et cetera, if that's helpful.
Fantastic. Jeremy, thanks so much for taking the time today.
Absolutely. Thanks everyone who's still on here listening. Hopefully this is helpful for everybody.
All right, that's our conversation with Jeremy Roll. What strikes me is his emphasis on developing your own market perspective, rather than just following what everyone else is doing. Jeremy's been through enough cycles to know that the most dangerous phrase in investing might be something like, this time is different. I feel like his approach is refreshingly honest. Admit when you don't know something, study the patterns that repeat, and have the patience to wait, to see better opportunities arrive in the market. Whether you agree with this end-of-cycle thesis or not, his framework for independent thinking is certainly something worth considering. If you found this conversation useful, please subscribe to the podcast or the YouTube channel, or share it with someone who might appreciate contrarian take on today's markets. I feel like we need more thoughtful voices in the investment conversation, not fewer. Anyway, thanks for listening. As always, I'm David Lofgren, and we'll see you next time on Multiple Perspectives.